Okay, investors, almost everyone I know loves a deal. Maybe it's a good Black Friday savings deal. Maybe it's a 20 to 30% off sale or discount. Fortunately, when it comes to the stock market, more often than not, over the long term, you get what you pay for. While the overall S&P 500 has averaged around 10% per year over the last 100 years and around 15% per year over the last 5 years, the annual return profile is far from linear each and every year. If you invest long enough, you're likely to endure unrealized losses and downside volatility of varied sizes each and every year if you're invested in the S&P 500 or any other index. The reward for investing in equities is the return. Investors, the risk is enduring the downside volatility at times. Here's some great data from Charlie Biello on annual drawdowns and their frequency. Look at that chart. Minus 5% declines in the S&P 500 happens nearly every year, while a minus 10% decline happens twice that rate. Happens nearly every year and a half, every 18 months. The dreaded bear market decline of 20% happens a little over once every 4 years, while a recessionary decline of 30% plus happens 1 out of 10 years. Investors, you invest long enough, expect at some point during your lifetime, the S&P 500 will lose over half its value. Given its rarity, let's call that one a generational decline. Even with the S&P, there is a wide discrepancy where this annual return comes from. Over the past few decades, higher quality, higher marginal return on invested capital companies that are growing faster or have more consistently tended to outperform lower growth, higher indebted companies. However, with this growth profile often comes a higher level of annual variance in stock returns. We've seen this dynamic play out a lot over the past few years post-COVID shutdown. Many times clients and prospects have expressed, quote, "All I want is higher returns with lower volatility." Yes, we have to educate them. That's not how investing in public equities work. I wish it was that simple. Unfortunately, when it comes to risk measured by return volatility and reward measured by annual return over long time periods, you get what you pay for. Yes, investors, there are times when the market shifts what it's rewarding from a style perspective. The new term that institutional investors call that is using factors. Sometimes it's pure price momentum is rewarded. That's when an investor buys a group of stocks because, well, other investors are buying those stocks and they're exhibiting price momentum versus the indexes. Other times, investors are looking for accelerating fundamentals from a revenue and earnings standpoint to buy. We've just been through a 2-month period where there was a titanic short-term shift in what factor investors will reward. Mid-October, the highest growth equities have lagged the overall market at the expense of more GARP, that's growth at a reasonable price, or even small cap value stocks being rewarded. Let's follow the data if you want a recent example of what I'm talking about. I'm going to use the return data since we exited COVID in the second quarter of 2020. So the data I'm presenting is from April 1st, 2020 through November 28th, 2025. Taking the S&P 500 equity index as the base return because that's what most equity investors nowadays compares themselves to, as over 50% of all flows into the stock market are in that index. The growth equity vehicle I'm using is the NASDAQ Composite, that's ticker symbol CCMP index. The more value-biased index almost everyone knows I'm going to use is the Dow Jones Industrial, whose ticker is IND. Here's the absolute return detail of these 3 indexes over the post-COVID time period. Approximately 5.5 great years for equities off the COVID lows. Here's that table. The annualized total return for all 3 indexes off the lows was greater than 17.5% per year. The S&P 500 returned 21.41%, the growth biased NASDAQ 23.48%, and the slower growth but more value biased Dow Jones 17.7% per year. All great numbers, all not likely to be continued in 2026. However, to achieve the highest compounded annual return of the NASDAQ, one also had to endure higher downside volatility. For example, in 2022, the markets experienced an earning recession, and the S&P 500 dropped minus 27.5% from peak to trough. Investors, higher growth NASDAQ fell by even larger percentage during this time, falling by over 37.7% peak to trough, amounting to an additional loss of 37% versus the S&P 500's decline. Alternatively, more value-biased and higher dividend yield Dow Jones Index declined as well, but it fell by less than the S&P 500, about minus 22% during this same time period, amounting to almost 19% less than the S&P 500's fall. Investors, while a lower magnitude difference, an investor will see a similar dynamic played out during this year's March-April tariff tantrum, with the growth indexes falling by a higher percentage than the S&P 500 and the value-biased higher dividend yield indexes falling by less peak to trough. Let's fast forward to this last November and get more granular on what happened in various indexes and sectors in the market during a volatile month to show you just how hard it is to change horses or styles mid-race. The S&P 500 and stock indexes were mixed during November, but it bounced hard over that last week, Thanksgiving week, over 3.5% just that week. So it finished up 0.1% for the month. The NASDAQ was down minus 1.6%, while the Dow Jones was up about 0.5% in a very volatile month. The main overall theme was big tech stocks and AI weakness and a rotation into defensive stocks. Following a very strong year-to-date performance, tech stocks dropped minus 4.4%, and they were the worst performing sector in the US in the month of November. Of course, tech stocks have been the best performer year to date and the best group since the COVID low 5.5 years ago. But that trend reversed sharply during November. Investors, had the markets not rallied significantly over the last 4 days of the month, this weakness would have been even more apparent. How bad was November for year-to-date growth leaders? Well, AI-related stock baskets, including the NeoCloud groups, was down minus 19%. Semiconductors were down minus 5.8%. Data centers were down minus 4%, ending the month with big losses. The Mag 7 stocks declined to minus 3.1%, and that's even with Google being up almost 14% in November. Investors, Nvidia declined over 12.5%, weighing on the group despite strong earnings. Post that early tariff blow, leaders in the retail trading themes got punished even more in November, with crypto down minus 17% and meme stocks down minus 10.2%. Economically offensive stocks and cyclicals declined minus 7.4%, while more defensive equities, which have materially lagged year to date, as well as since the COVID lows, outperformed with a gain of up 11.2%. That was led by healthcare stocks being up 9.1% in November, benefiting from cheaper valuations and a tariff clarity. Investors felt this said year to date. As of this writing, the growth-oriented NASDAQ was still up almost 21.75% year to date on completely price return. The core S&P 500 index was up 17.8% in total return, split between about 16.5% price and 1.3% dividends, while the more value-biased Dow Jones index was up almost 13.9%, and that's 12% in price and another 1.9% in dividends. But investors, remember, you get what you pay for, and to generate the higher growth of the NASDAQ stock index, you had to endure much higher volatility in the form of larger downside losses during the April minus 21% sell-off in the S&P 500, as well as November's brief decline of 6%. Investors, what does this all mean to you? Our advice to viewers is to meet with your financial advisor, determine how much risk or potential losses you're comfortable with over your given time investment horizon. From there, your advisor should be able to design a portfolio of investments blended from tools that weigh capital growth, capital preservation, or income generation that will best meet your needs over your retirement, so long as you stick to your plan and you don't try to change horses or riders mid-race. However, investors, remember, there are no guarantees in investing in equities, even though over long time periods, they've proven one of the best ways to save, compound wealth, and combat inflation. Investors, whether you desire growth or income, or a combination of both in your portfolio, the entire Oak Harvest team is here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.